Hi and welcome to Clarity for Sure. Welcome to this essential update on India's debt markets. Today we are diving into SEBI's latest consultation paper on high value debt listed entities or HVDLEs released on October 27th this year. First, a clear definition for clarity. HVDLEs are Indian companies that have listed non-convertible debt securities like bonds or debentures on stock exchanges with outstanding principal exceeding a SEBI defined threshold. Introduced via 2021 amendments to the Listing Obligations and Disclosure Requirements or LODR regulations, these entities must adhere to equity like corporate governance norms. This ensures independent directors, audit committees, related party transaction approvals, and quarterly reporting to safeguard debenture holders and ensure transparency. The initial threshold was rupees 500 crore based on March 31st, 2021 data. It rose to 1000 crore effective from this year's March 27, with compliance mandatory from April 1st, shifting from a comply or explain basis. Currently, 137 entities qualify, mostly non-banking financial companies or NBFCs raising debt through private placements. Now the headline news. SEBI's October 27th consultation paper seeks to ease these burdens while balancing investors' protection. Here's what it proposes step by step. First, raise the threshold from 1000 crore to 5000 crore or possibly 2000 to 3000 crore as alternatives. Second, introduce a sunset clause if entities' outstanding debt dips below the threshold for 3 straight years. Third, streamline ease of doing business measures. Fourth, a dedicated LODR chapter proposed as Chapter 5A for HVDLEs, reducing overlap with equity rules. Fifth, transition grace 6 months to comply if crossing the threshold mid-year with disclosure from the third quarter onward. Why these changes now? Because market feedback highlights the pain. NBFCs and housing finance companies often hit 1000 crore via small tranches, incurring higher costs for board restructures and reporting. With India's corporate bond market at rupees 36 lakh crore, over-regulation stifles growth, especially as we eye global index inclusion. These tweak targets truly high-value debt above rupees 5000 crore, retaining trustees' oversight for others. The benefit of these changes: lower cost could spur issuances, deepening our bond market. For investors, it maintains protection for large exposures but risks slightly reduced transparency in the 1000 to 500 crore bracket. Globally, this mirrors mature market lighter rules for debt-only listings.